it's Don Kaufman, and welcome to our Black Friday sale here at TheoTrade. We're going to offer a 1-year TheoTrade subscription at $799. Now, if you're brand new, not necessarily familiar with what a TheoTrade subscription consists of, well, TheoTrade includes everything that you're going to need to invest in trade. We do classes. Over the last 5 years, we've actually done over 97 full-blown courses. All the different instructors here at TheoTrade. We have daily coaching sessions with continued education from Professor Jeff Bierman. We give you email access to all of the instructors. Yes, you can email us your trade ideas and we will ping you back, okay, with opportunities, fixing the trades, answers to your questions. We provide a live trading chat room. That's literally the entire trading session. And we will text out and do push notification of live trades. We provide you all of our indicators and scans from day one. And we give you mobile access to where you can even download the classes, download the coaching sessions, and watch them while you're offline. Literally everything that you're going to need to succeed in this business, okay? In addition to that, we are going to grandfather that $799 rate for future years here at TheoTrade. People, this is it. This is the last time that TheoTrade will offer the $799 for a year rate. This is it. The last Black Friday that we will offer $799 for a year. Go now to theotrade.com/B as in boy, F as in Frank, 799. Again, that's theotrade.com/B as in boy, F as in Frank, 799. Welcome to TheoTrade. This is Don Kaufman. September 27th, 2020. We are minutes here after the cash close on this shortened kind of holiday trading session. I wish everybody here a happy and hopefully very healthy Thanksgiving kind of season, obviously coming into, well, some of the holiday season in general. Nevertheless, what we're going to cover on this week's update is really, well, is all going to remain quiet into, of course, the end of the year. And that's where I'm going to take a little bit of a stance here and tell you right now, implied volatility, I would anticipate is going to be on the rise. We should actually see some real price action inside of the markets here in days to come. And again, in just a few minutes, I'm actually going to display that here when we look at a couple of charts, a couple of trade ideas. You know, the market's net this week, what did we do? You're going to say, oh, it's low volume, nothing happened over here. A lot actually happened. Again, we're going to look in detail here in a moment at the monsters of tech. Now, the monsters of tech is a symbol that we created, which is your Apple, it's your Google, it's your Facebook, right? It's the monsters of tech. It's your Amazons, all compiled together into one lovely little index. And what you're going to see, they haven't actually had a lot of positive price action. People, it's all Tesla. Tesla is not per se one of, you know, the quote-unquote monsters of tech. Nevertheless, you're going to see that the NASDAQ is actually driving the entire marketplace. In fact, in last weekend's update, I was talking about low liquidity. In this week's update, I'm actually going to show you not only low liquidity, completely anemic liquidity, specifically inside of Google, where you had a few thousand shares that moved that stock more than 15 bucks at several of the cash opens throughout the course of the week. So with that, let's not hesitate anymore. Let's jump into it. Let's look at a couple of charts, a few trade ideas. All right, to the charts and trades we go. So the big question in this weekend's update, will markets hold it together until the end of the year? I mean, it's almost hard to say this, but you know, you got marketplace at effectively the all-time high. Say what you will. I mean, we could talk about the economic, you know, picture kind of decaying out here. In fact, we're going to make a couple of points right off the bat here. You know, economic picture is decaying. There's a lack of stimulus right now. There's unemployment benefits dropping off for tens of millions. Those benefits are dropping actually December 26th. Retail sales, big question mark under the retail sales because this holiday season, again, you would believe was going to be diminished to some degree. Corona numbers are absolutely exploding. There's a possibility of more lockdowns. And the markets, yet they've just completely decoupled, it feels like, from the economics behind, you know, everything that's out there right now and going on is the decoupling of this marketplace. It doesn't matter. There will be stimulus. It doesn't matter. Janet Yellen is taking over. It doesn't matter. The Fed has got our back. And it just keeps going and going. And what we're going to point out here is that, first and foremost, I would expect some fairly tumultuous volatility even into the end of the year. So when we talk about, well, markets hold it together, I'm going to, cut to the chase and tell you right now, again, you have to anticipate some fairly wild implied volatility. Let me actually detail, first and foremost, what is holding the markets together. Okay, then we're actually going to get specifically into some trade opportunities if you believe volatility is forthcoming. And I'm actually going to show you three very, very different types of trade ideas. So again, what is holding the markets together at this point in time where I said, the S&Ps are pretty much effectively at their all-time high or near the all-time high here, okay, in terms of a closing high. Again, he pretty much takes the cake here inside of the spiders. If you want to go look at the IWM, it's there, all-time closing high. You want to take a look at the QQQ. Oh, the QQQ is a hop, skip, and a jump away from it. But net, what holding the market together right now, the Russell, the financials, and energy. And I want to detail this for just a moment. When I talk about the Russell, I like to look at the IWM. The IWM has had just a ridiculously explosive move to the upside in recent weeks. And again, with the Russell comes the financials, which in this case, I'll actually look at the XLF. With the XLF comes the XLE, which is the energy sector. And what's interesting about this, though, is when you start looking at these three areas, okay, on a percentage basis, and this is something I've been pointing out just kind of incessantly here at TheoTrade. If you take a look at the IWM at a percentage basis in year-to-date, okay, it's up 11%. Then we flip it over and we look at what? The financials. The financials are still down about 8.5% year-to-date basis. And last but definitely not least, you take a look at the energy sector, which is still down almost 36% in the year-to-date basis. And that's why I say, what's really holding the market together? Well, first of all, okay, these three areas rallied, as I said again, massively, statistically ridiculous numbers. And when you start applying also like auto expected moves, look how far outside expectations, okay, we were. I mean, the market is just getting it that wrong. Take a look at the financials here, ripping it apart. You look at the IWM, it's Mr. Toad's wild ride to the upside. My take, this is a really, really dangerous rotation. Okay, that I wouldn't read much more into the rotation because you're not going to convince me that, stimulus, it'll save us all, Yellen. Okay, I mean, listen, okay. Again, my take, dangerous rotation. It's just looks like it's based on funds just buying the losers on the year. What has not performed this year? Let's just pile into it, okay, towards the end of the year. And that's all that you're seeing. And yes, okay, it was sparked after the election. And yes, this massive rotation occurred after the election. And or you could also say that it was the vaccine news, if you would like, that sparked this. I don't buy either one of those scenarios. I think this is plain and simple, okay? Buy what hasn't been working throughout the course of the year, and that's why I think it's such a dangerous rotation. The other aspect that just strikes me as extraordinarily dangerous is the monsters of tech. And the monsters of tech, this is what got us here. And this is what I was talking about in the video portion. It's Apple, it's Amazon, it's Facebook, it's Google, it's Microsoft. Again, I don't include Tesla into the monsters of tech, but yeah, there might be room for that coming here very, very soon. So the monsters of tech, one of the things that's troubling is that on a percentage basis, listen, no doubt, they're stellar, right? They're up 42% year-to-date basis, but they haven't been the performer right now. In fact, in recent weeks, they've actually net dropped a little bit, and you could actually make the argument they haven't done anything literally since mid-October to actually stage gains. That's not to say, it's not to say that the monsters of tech cannot come roaring back, but when you start to look at them individually, there isn't necessarily damage being done, but like Microsoft hasn't done anything literally since fairly early in the summer. Okay, you start looking at Apple, same tune. This is actually from August. Just take a look at Facebook. Facebook has a very, very mild upward bias, but net since August hasn't done very much. Okay, Amazon, you're like, but Amazon, it's retail. It hasn't done anything. Okay, and again, you got to go back to July over here. Net Google. Okay, Google is your performer. in here. And one of the things that I really wanted to point out, specifically with some of the monsters of tech, okay, and what's really driving the market. Again, I'm going to talk about the monsters of tech. They're underperforming. It's all about Tesla. Let me actually show you Google, okay, on an intraday basis. Now, granted, this was a holiday kind of trading session here on this Friday. You know, some holiday trade. But the point being over here is you start to kind of zoom into things. Now, granted, there's Google L and there's regular Google. Okay, but take a look at this wicked move. This wicked move that took us from roughly, let's call it 1765 and a straight shot up to about 1780. Okay, you all have to agree that's a $15 move. And I'm just going to isolate to those. These are minutes, people. Those are 4 minutes. Take a look at some of the volume that actually drove us there. Okay, I just want to throw my mouse in there. That's 1,140 shares, and then in the next minute's in 2,642 shares. I know what you're thinking, because some of the trade is going through Goog as well. Okay, which absolutely unequivocally is. So what was Goog doing at the same time? Oh, lo and behold, it had almost 3,000 shares, and then the next minute, I'm being facetious with this for the point. People, we have a marketplace that's moving right now on absolutely, okay, absolutely no liquidity whatsoever. And it is alarming on many, many fronts. I mean, we can also take a quick glance at Amazon, which is, of course, you know, you'd probably argue this thing is like, you know, the mother of all products. This is the cash open specifically today, but let's not even use today. Okay, you can go back to any recent trading session over here. This thing can't even squeeze out, you know, 10,000 shares consecutively in any minutes. And granted, it's almost a $3,200 product. But again, the volume is absolutely unequivocally anemic out there. Then I'm going to throw something even crazier out. And again, I was talking about in last weekend's update all about volume and all about liquidity. And I wanted to show you Tesla, because Tesla traded 37 million shares. Again, in this holiday trading session. Look at this. Tesla did. Okay, and I'm just going to highlight it for a second, because this is imperative that you guys see this, because it's the basis to which I think and believe we're going to see a lot more volatility in this marketplace. You did 1.45 million option contracts specifically inside of Tesla, which is a $585 product. Okay, I want you to compare that. Again, that's in a holiday trading session. I want you to compare that for a second to the spiders. The spiders, okay, hands down, this is like the mother of all products. Do you realize that the spiders only did 1.8 million contracts, but the spiders, okay, are only what? $363 product. If you looked at this in terms of the notional value, that's like how much capital is actually flowing through Tesla versus flowing through spiders, you should be alarmed, because you're going to find out pretty quick. Tesla's actually putting more capital, well, through it than the spiders right now. And that, people, okay, that is, you know, it's one of the signs out there. I mean, the spiders only did 27 million shares in holiday trade, and Tesla's outperforming it. Okay, in every way, shape, or form. And you're like, how can little Tesla, which only ended up about $11 in a day, how can this thing not only, okay, you know, trade more in terms of notional value than the spiders, okay, but how can Tesla actually move markets? And again, this comes down to the fact that, and I was reiterating from something the other day, this thing is a $555 billion market cap, okay, which, again, is nothing in comparison to Amazon, which is a $1.6 trillion market cap. But if you actually look at the implied volatility, Amazon's about a 30% implied volatility. In fact, Amazon, it's 35% implied volatility. And then you look over Tesla. Okay, Tesla's actually up in the 90s. Tesla is precisely, okay, about 3 times, okay, the volatility, which makes its, what, $500 billion market cap just as powerful as Amazon. Net, what do you have over here? You have the entire market resting on the shoulders of none other than Tesla, which is probably in a wicked squeeze right now, just ripping the shorts apart. I'll tell you right now, I do not have a position in Tesla. I don't necessarily think I'm going to be taking a position here in the near term, but I am telling you this, okay? You now have the fate of not just the NASDAQ, but the fate of the S&Ps resting in the hands of what? Elon Musk? That makes me feel warm and fuzzy at night. It's no joke, because that's exactly where we are. Okay? Listen, net, throughout the course of this week, pretty much the entire marketplace, ended right on the upper edge of the expected move. Okay, and there's nothing really to denote about that, because for the most part, what I'm saying here in the SPX, we were just a hop, skip, and a jump outside the expected move. That counts, people. That's pretty much at the expected move. Take a look at the QQQ. In the QQQ, we apply auto expected moves. That too, right pretty much into the edge of the expected move. The IWM right on its upper edge of the expected move. And the reason I'm just going through this really quick is I just wanted to say this week, which really only had what? Well, 3.5 trading sessions, was kind of humdrum. It was normal. When you just drive mildly higher like that with inside, or right to what we call the edge of the expected move, okay, it's pretty much a gimme. It's a layup of a week, whatever, we'll move on. But here's the point. Volatility, okay, I would fully anticipate, again, and I'm reiterating this, to pick up in the coming weeks. And one of the reasons being is that, first of all, there's a lack of liquidity. Nobody's looking for it right now. In fact, there's even a contraction of implied volatility, which I'm going to show you here in the SPX. In fact, we'll jump back to some of the trade ideas. We'll go right to the SPX right now, because I've already got drawn on your screen the expected move for this next week. And I'm telling you, this is what's important in the marketplace. It's not about, I think we're doing this and I think we're doing that. We're going to see very likely an expansion of volatility. First of all, okay, some of my reasons for this. This past week, which again was a holiday trading week, which only really had 3.5 trading sessions to it. This past week had about a $67 expected move, meaning we're supposed to move $67 up, $67 down. What do we do? Pretty much hit it spot on. Listen, okay, we're what? We're about $8 to $10 outside of the edge of the expected move. To me, that's a gimme. Now, this next week, which is going to be a full trading week, this next week, what did they do? Okay, they only expanded the expected move by $3. It doesn't make sense because we tagged the edge of the expected move this week. Okay, you expect that we're probably going to make $70 move. No problem whatsoever. So when you start looking at this, a $70 expected move higher or a $70 expected move lower for the coming week, that would make me extraordinarily nervous, because again, with the full 5 trading days, we're ready to rumble right now. And we're ready to rumble because there's no liquidity in any of the monsters of tech. Okay. You've seen the financials, which are, to me, the financials are an overblown disaster at this point to the upside. Right. The energy sector has looks like it's already starting to pull back in here. Then we have the IWM, the Russell, the little engine that may have possibly topped out. Okay. What do you have actually holding the marketplace up? You're like, oh yeah, Tesla. That's it. It's the world according to Elon Musk at this point that's actually holding it together. So again, look for an expansion in volatility. Look for a pickup also in the volume. A couple of trade ideas on this particular front. I'm going to rip through these quick. Number one, if you take a look at Intel has had an amazing run lately to the upside. That's exactly why I think it's a wonderful candidate to get short. Now, in terms of getting short, you can see I've got a position out here 21 days out. If you were going to go in, you were going to try to follow something like this, maybe only go 27 days out and use what we term kind of an in-out spread. Okay, about 1 strike in the money, 1 strike out of the money, boom, done. This is a 48.50, 46.50 put spread for about $1. You risk $1 to be able to basically make $1 in here. I wouldn't go much further than 27 days out, because I want to give myself enough time to be right, enough time to be wrong. But I also, want to do a short enough time frame that this trade has some time to expand. All right, with that, the next trade on the docket here is the IWM. What am I looking for specifically inside of the IWM? And that's, well, what I'm going to detail. If you take a look at the IWM, it's not just about the fact that it keeps cracking the expected move. Yes, it keeps cracking the expected move, which is why I'm watching it. But it's also the implied volatility. The implied volatility is absolutely rock bottom in here inside of the IWM. And I've already got trades on in here, but I would actually look to buy a gamma iron. This is where we actually go out and actually purchase an iron condor. That's right, buy side iron condor about 42 days out. And again, I've got one on already, some 21 days out. And if you take a look at this, and again, I've got this on in a multitude of different accounts in different ways, shapes, or forms. Here I am approximately 30 some odd days out inside of the gamma iron. Again, this is buy side trade. So why am I doing it? First of all, again, low implied volatility, and net, if the explosion to the upside continues, I want to be part of it. And if this product completely and totally craters and implied volatility picks up, I also want to be a part of it. I think it's a wonderful time with implied volatility contracting, with the product absolutely exploding, to be a buyer of an iron condor. Last but definitely not least, if you do not have one of these on, you might want to consider it, a VIX volatility spread. You can see I'm already out here in January. Not to confuse things, I'll switch accounts, okay, clean things up here for just a moment. So you can see out in the January time frame. What I would do in a VIX volatility spread, is I would go out and I would actually sell like a $5 wide put spread with the anticipation of volatility to go up. I would sell a $5 wide put spread to do what? Well, to turn around and buy something, okay? What would I possibly want to buy? Listen, again, I'm going to take an outside shot. I don't think volatility is done. What you're looking at over here in this VIX volatility spread is I'm selling a $5 wide put spread that's roughly close to the money to buy an out-of-the-money call spread. As long as implied volatility, and specifically the VIX, stay above 20, I am just fine. And I'm able to buy a $25 wide, okay, call spread, and I'm doing it for a net credit of 5 cents. That's a VIX volatility spread. It's an outside shot just in case volatility explodes. Again, that's it on this weekend's update. As I said, will markets kind of hold it together? Well, I don't believe so. I think, again, we're going to see an expansion of volatility because eventually these factors here, the economic picture decaying and lack of stimulus, unemployment, retail sales, the corona numbers are exploding with lockdowns, markets just being completely decoupled, I think it's going to come to an end. Okay, situation, people, is going to come to a head. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.